The problem is, the days of business as usual are over. Jamie Dimon's latest insight casts serious doubt on the idea of a soft landing, signaling that inflation may linger, debt is hitting record highs, and global instability is on the rise. If you've been counting on things staying steady, now's the time to think twice. The stakes are massive. What does it mean for you, for your investments, and for financial stability overall? Today, I'm breaking down the major shifts ahead. What is driving inflation? Why did our debt increase over the last 5 years exceed the total debt of the previous 200 years? And is the market aiming for a meltdown or a melt up? Alright, let's break down this whole inflation thing, because I know it's a word we keep hearing, but what's actually going on? Jamie Dimon's been pretty vocal about it, and if anyone's got a front row seat to the economy, it's the guy running the biggest bank in America. Now, inflation isn't just about prices creeping up at the grocery store, there's a much bigger game at play here. So why are things getting more expensive? Dimon points to several big reasons, and it's not just a one-time thing. I am talking long-term structural stuff. First up, let's look at military spending. You might be thinking, well, what does that have to do with my grocery bill? Actually, a lot. The US has ramped up defense budgets, and wars and geopolitical tensions are pushing other countries to do the same. When countries pour money into their military, they're often not as careful about how much they spend, and that money's gotta come from somewhere, usually from printing more cash or borrowing, both of which push inflation higher. In 2023 alone, the US spent a massive $916 billion on its military. That's a 2.3% increase compared to the previous year, and globally, military spending is up by almost 7%. All that extra spending, that all adds fuel to the inflation fire. But it doesn't stop there. Dimon also points out that the fiscal deficits in the US are a huge factor. Basically, the government's spending more money than it's bringing in, and when that happens, it usually means they're borrowing more. Let me give you an everyday example. It's like maxing out your credit card month after month, and instead of paying it down, you keep borrowing more. Over time, that debt builds up and the interest starts to snowball. And who covers that? It's us, through higher taxes or inflation. It's all and there's more. Dimon highlights a few other forces that might not be obvious, but are definitely at play. The shift towards a green economy, for instance, that's another driver. Now, I know everyone wants to go green, and it's awesome. But building new green energy infrastructure takes a ton of investment, and that money doesn't just fall from the sky. It's coming from government spending, which, you guessed it, is inflationary. And then there's the demographics. An aging population means more spending on healthcare and support systems, and a slower growing workforce that can create labor shortages that drives wages up. All these things pile on top of each other and they keep the inflation machine rolling. Now, Dimon's message is clear. Inflation isn't going away anytime soon. Even if we see some dips in the short term, these long-term pressures will keep pushing prices up. And he's not alone. Many experts are saying the same thing. There's more inflation ahead. So what does that mean for you? Well, it's not just about the price of your favorite coffee going up. If you're an investor, you might be thinking about how these inflationary forces could impact your portfolio. Higher inflation means higher interest rates. And that can mess with everything from real estate prices to the stock market. Here's where things get interesting. Dimon and others believe that the Federal Reserve might not have many tools left to combat this. They've raised interest rates aggressively, but if inflation keeps coming, their hands might be tied. It's kind of like being caught between a rock and a hard place. They can either keep rising rates, and that slows down the economy, but risks a recession. Or they hold off, and they watch inflation keep eating away at everyone's purchasing power. Neither option is great. So as you can see, inflation is more complicated than just prices going up. It's connected to everything: military spending, the green economy, government debt, demographics, you name it. And if you weren't paying attention, it's gonna hit us where it hurts: our wallets. That's why Dimon's saying that we've got to be cautious and think long term. So, we talked about inflation, but now let's dig into something that's fueling it even more: the US debt crisis. And when I say crisis, I'm not trying to be dramatic. Just take a look at how fast the national debt has grown. It took the US over 200 years to accumulate its first $11 trillion in debt. And guess what? In just the last 5 years, we've added another $11 trillion. It's like the debt clock's on steroids, and it's not slowing down anytime soon. Now you might be wondering, okay, so what's the big deal? Isn't debt just part of how governments work? Well, yeah, you're not wrong. Countries do run on debt all the time. The issue is that debt gets so massive, it starts creating this vicious cycle. The US government needs to borrow money to cover its expenses because they're spending way more than they're making. It's kind of like taking out a new loan to pay off your old one, and then doing that over and over again. Except each time, the interest rate gets higher. That's pretty much what's happening right now. Here's how it works. When the government borrows money, they issue treasury bonds, usually these IOUs for investors. In the past, when interest rates were super low, this was manageable. The government could take on a ton of debt without feeling the pinch because they only had to pay a tiny bit of interest. But now, with the Federal Reserve hiking up rates to combat inflation, the cost of borrowing is through the roof. It's like if you suddenly had to pay double or triple the interest on your mortgage. It's gonna hurt. And this is not just a minor issue. The government's interest payments are now one of the biggest expenses in the entire budget, up there with defensive spending and healthcare. I am talking over $1 trillion just on interest. To put that into perspective, that's more than the entire national defense budget, which is already massive. The US is trapped in this cycle where it needs to borrow more just to cover the cost of borrowing. And every time they issue new debt, they're doing it at higher interest rates, which just keeps piling on. Now, Jamie Dimon and other experts are worried because this situation is basically a ticking time bomb. If interest rates stay high, which they probably will to keep inflation in check, the cost of servicing this debt is only going to get worse. And if the government can't pay it back, well, they've got two options. Either they cut spending drastically, which, let's be honest, is not going to be very popular, or they find a way to refinance. But here's the twist. Experts believe the government might actually manufacture a crisis to force interest rates down and make refinancing easier. Sounds a bit like a conspiracy, right? Well, there is some logic to it. Let's break it down. If the economy is strong, unemployment is low, and the GDP is growing, the Federal Reserve doesn't really have a reason to lower rates. But if a crisis suddenly pops up, something that causes economic instability, the Fed could justify slashing rates again. By doing this, the government could take advantage of those lower rates to refinance its debt at a cheaper cost. It's almost like hitting the reset button, but it comes with its own set of risks. If this manufactured crisis happens, it could create a lot of uncertainty in the market, leading to volatility and potentially a stock market crash. And for regular investors, that could mean rough times ahead. Think of it like this. If you've got money in the market, and suddenly the Fed starts cutting rates aggressively, that could either boost the market temporarily or create absolute chaos if investors panic. It's a double-edged sword. Sure, lower rates make borrowing cheaper, but it could also signal that something is seriously wrong. And that's the challenge investors face. You need to be prepared for either scenario. Whether it's a temporary market melt-up, where everything rallies briefly before a downturn, or a prolonged period of volatility that hits your portfolio hard. And here's another thing to think about. Even if they manage to lower rates temporarily, the debt isn't just going to disappear. It's still growing, and eventually those bills come due. Jamie Dimon's concern is that if the government keeps kicking the can down the road, they'll end up facing a much bigger crisis when they have no more tools left to manage it. And that could be catastrophic for both the economy and regular people like us. So, what can you do about it? It might sound daunting, but it all boils down to staying informed and making smart decisions with your money. If interest rates remain high, it could affect everything from home loans to the stock market. So, keeping an eye on those trends, that's not just for the experts. It's crucial for anyone trying to protect their finances. The debt crisis isn't some far off problem, it's happening right now, and it's going to play a major role in shaping the economy over the next few years. The key takeaway here is that the debt is growing faster than ever, and if you're investing, you need to understand how this could impact everything from stocks to bonds to your retirement plans. All right, so we've talked about inflation and the skyrocketing debt, but now we've got to address the big elephant in the room. What does this mean for the market? Is it going to crash, or are we going to see a melt up? Or is something else entirely going to happen? If you've been listening to Jamie Dimon and other experts, there's a lot of speculation flying around, and honestly, it's making people nervous. First, let's tackle the concept of a market crash. A lot of folks out here, including Dimon, are hinting that if things don't get under control, the market could face a serious downturn. Think about it. If the Federal Reserve keeps interest rates high to combat inflation, borrowing costs stay elevated, which can put the brakes on economic growth. When growth slows, it usually means stock prices start to fall. That's the classic crash scenario, right? But wait, because there's more to it than just high interest rates. Jamie Dimon and other experts point out that geopolitical issues and government debt are wild cards that could trigger market volatility. Tensions continue rising overseas, and we've seen conflicts involving Ukraine or other global hotspots. These situations don't just affect those regions, they ripple out into the global economy. Supply chains get disrupted, oil prices fluctuate, and the markets react, usually not in a good way. And let's not forget, if the government's already swimming in debt, any additional conflict means more spending, which adds even more fuel to the fire. It's like pouring gasoline on an already blazing inflation fire. But what about the other side of the coin? Some experts, including those in the melt-up camp, believe that before any potential crash, we might see the market go through one last big surge, a melt-up. If you're not familiar with that term, a melt-up happens when prices skyrocket due to investors flooding the market, often out of fear of missing out. It's that moment when everyone rushes into a party because they think it's the place to be, only to realize later that it was all hype. In this case, hype could be fueled by the government or Federal Reserve stepping in to prop things up, especially if they sense that the economy is on the brink. Now, why would they do that, you ask? Remember, the manufactured crisis idea that we talked about earlier? If the Fed slashes interest rates suddenly or injects more money into the economy to create a sense of security, we could see a temporary surge in stock prices. This might feel great at first. Your portfolio goes up and everything looks rosy. But here's the catch. Melt-ups are often followed by steep crashes. It's a sugar rush. You want that quick boost, but eventually the crash hits, and it is not pretty. Jamie Dimon himself has warned that while a market melt-up could look like a win in the short term, it's essentially masking deeper issues. If the fundamentals aren't strong, like if companies are still struggling with high borrowing costs or supply chain issues, the whole thing could unravel. And that's why Dimon's take is so crucial. He's not saying we're doomed, but he's emphasizing that these short-term booms should not fool anyone. It's like putting a band-aid on a broken toe. Sure, it will cover it up for a while, but it's not going to fix your underlying problem. So how do you protect yourself as an investor when there's so much uncertainty? Well, the first thing to remember is that timing the market is nearly impossible. I know, we all want that crystal ball to tell us when to buy and sell, but let's face it, no one's got that kind of accuracy. Instead, Dimon suggests focusing on long-term strategies. That means diversifying your investments. Don't put all of your eggs into one basket. If you have stocks, maybe look into bonds or other assets that might hold up better if the market goes through a rough patch. And if you've already invested heavily in stocks, it might be worth revisiting your portfolio to see if it's too exposed to risk. Another strategy is to keep an eye on those government moves that we've been talking about. If the Fed starts cutting rates aggressively, or if there's a sudden push for new economic policies, it could be a signal that things are shifting. You don't have to be an economist to spot these trends. Just stay informed and look at how the market reacts. If you see a sudden spike that seems too good to be true, it's worth considering if it's just part of a melt-up scenario. Dimon also stressed the importance of having some cash on hand. In uncertain times, liquidity is key. Having money ready means you can take advantage of opportunities if the market does dip, like buying stocks at a discount when everyone else is panicking. It's about staying prepared, not reactive. And yes, I know that's easier said than done, right? The point is, being proactive now can save you a lot of headaches later. Finally, let's talk about what happens if the market does crash or melt up. It might sound dramatic, but history shows that these cycles aren't new. The important thing is to not panic. If you've got a solid long-term plan, sticking to it is often the best move. Panicking and selling off everything at the first sign of trouble can lock in losses that could have been avoided with a little patience. And remember, even if things go south, markets have a tendency to recover over time. Want to know what Warren Buffett thinks of the current market situation and what he's doing to combat it? Click the video on the screen to find out.